Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to the next installment of Investment Friday with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. We've got some interesting topics to talk about today, a little bit of a market update, and then we're going to talk, should you get more conservative when you get to retirement, and what's going on with options as a follow-up to last week's episode about the VIX, the VIX index. So, Brad, thanks for being here, man. What's up?
You're welcome. Hey, thanks for having me. If you'll notice, I wore green because it was green on the screen today. The stock market was up today. Again, we're recording this Thursday afternoon of September 14th. So just in case anybody, if it's not up tomorrow,
right,
this is released, they won't think I was, just pulling their leg.
Right.
Yeah, things are going well. Things are going really well. How are you?
Oh, I'm good. Recorded a couple podcasts today, and some new things happening in the Hannah Chapman world. So it's good. It's
Awesome.
good. Yeah. And it's almost fall. We're getting some of those like glimpses. The tops of the trees in Cincinnati are starting to turn red and orange. And so this is my favorite season for sure. So I'm really excited.
That's nice. In Arizona, the cactus don't turn any colors.
I know.
It's just always green and spiky.
Right? And brown. And there's so much. I'm always so like when I go from especially Ohio in the summer and go back to visit Arizona where my family lives, I'm always like, wow, there's a lot of brown.
Yeah.
So much brown.
Brown, pinks, and purples.
Yes.
That is the that's the state flag. So what are you going to do?
So let's talk about what happened today a little bit, and what we're kind of looking out for over the next couple of weeks. And then we'll move into our listener questions. So give us a rundown of the news that happened and came out this week.
Perfect. So we had the United States CPI, which is the Consumer Price Index, which is a measure of, for the average urban consumer, what their inflation rate looks like. And it virtually came out as expected. It was not market moving in any way. It kind of confirmed what we were already expecting in terms of inflation. And so again, it didn't really move the markets that much. It kind of gave them the comfort that we're as is. Similarly, the PPI, which is the United States Producer Price Index, so it's that measure of inflation within the manufacturing, within the fulfillment chain, if you will, of a service and a product, how, what kind of inflation you experience there. And it also came out today pretty benign, as expected, didn't really move any markets that much, kind of confirmed that we were at a pretty decent level with that index. Also, the European Central Bank came out, raised rates, kind of intimated that this might be their last interest rate increase. And so with that kind of cessation of hiking interest rates, you had risk assets, meaning stocks and real estate and some commodities, actually really start to rally pretty nicely today. I mean, I think the S&P was up 79 or 87 basis points, which in my vernacular or in other people's vernacular would be 0.87%. So almost just shy of 1% for today, which is a fantastic showing. I also want to comment, small caps, which have trailed for a very, very long time, actually came in with a very strong 1.7%, a little over 1.7% today. So again, hopefully this means it's the rally this year is starting to broaden out and starting to have the other stocks catch up with those spectacular seven, which have done so well year to date.
So Thank you for mentioning that, because it pulls in two things that we've been talking about for a while. I mean, honestly, I sometimes forget that we're in the middle of September already, which is like freaking me out. So we've been talking about this since the beginning of the year, is that um, we are looking for small caps to come up, right? To come back up to reversion to the mean, basically. And so you're mentioning you're seeing that today, right? With the um, interest rate pauses, potential, right? Looking into the future, saying, oh, we might actually be at that point where interest rates aren't going to go up anymore. So small caps can finally come back up. And that's exactly what we've been saying for months now. And this other point that even though the very biggest companies in the S&P 500 have done spectacularly well this year, that it hadn't been a broad-based recovery. It had been a very narrow recovery. And so once
Exactly.
again, this might actually be broadening out, where we don't need to, this is what you also mentioned before, we may not need to see those spectacular seven, quote unquote, fall. We could see the rest of the, stocks in the indices rise up to meet them.
Correct. That's
So,
exactly right. I mean, for most people, as we're sitting here as of today, the S&P 500, the headline index, is up about 17, 18% year to date. The S&P 500 equal weighted, so it's the exact same holdings as the two index have the exact same holdings. The only difference is one is capitalization weighted, so it's weighted based on the size of the company's market cap, versus in the equal weight, each position is equally weighted. It gives you a better indication of what the average stock is doing. And the average stock right now is up 5 to 6%. Okay. So really quite a difference between 17, 18% and 5 and 6% year to date. So that's that wide dispersion between the two must narrow. And I personally think that it's going to be a catch up versus a falling of those those top 7 to 10 stocks.
well, we will see what continues to happen. But yeah, if today was kind of a promising, or at least a positive step in that direction, um, we'll see if it
I,
keeps going.
I hope so. Now there's a risk for tomorrow.
Oh,
One of the big events over the next couple of months, which I want to have people really kind of pay attention to, because this does have a pretty big impact, or at least it can have a big impact on the U.S. economy, is the United Auto Workers Union. Their negotiations expire tonight. Their contract expires tonight. Now they've been negotiating for a while now, try to lock in a better contract for the future. Different pieces of news coming out saying it's hopeful but not hopeful. So if they go on strike, that's going to be a big negative in the negative column for economic growth. Okay. The big three employ a lot of people, and a lot of people that make decent money, and so that's gonna crimp consumer spending a little bit, potentially could, towards the fourth quarter of this year, which for consumer spending is the biggest quarter.
yeah. So is there any with your experience in the industry, I can remember times when, the UAW had some pretty prolonged strikes. But I can't remember from like an investment standpoint what happened with that. Do you have any recollection of maybe what that's looked like in the past if there has been a prolonged strike?
Yeah, it's generally a short-term negative for those stock and those industrial stocks in general, because it's not just the big three; it's their entire supply chain, right? Because if you're not selling cars, right, because you're not making cars, then everything from the auto dealership that sells it to you as a consumer, if you go all the way back to the raw material producer, the miner, it impacts every single company in that supply chain. And there's a tremendous number of people that are employed in those companies. So it becomes a it can be a big negative for U.S. economic growth in the short term. Okay. Generally, these are so painful for both the union and the automaker that they generally try to get over this pretty quickly. Nothing gets people serious when money stops coming in. So they all of a sudden it really focuses them on what's important and getting back to work. Second thing I really want people to watch out for is the government, the federal government, the potential of the federal government shutting down for a week or two. Okay. And while, yes, all those employees, most employees get furloughed in the federal government, and they do, yes, get back pay once it's resolved, it still is a pretty big negative hit to the psychology of the consumer and can impact a significant amount of consumer spending during the fourth quarter. So again, that could be a big negative for what potentially could be a weakening labor market between now and then. So it's one of those things that it's not necessarily baked into the economic projections, certainly not into the equity or bond markets, but is out there in terms of a risk.
I always appreciate your ability to bring temper everything. So,
well, there's an old saying, and I don't know who said it. I think it's Confucius, but I'm not sure. So don't quote me on that. It says it's never as bad as it seems, and it's never as good as it seems. So it's always somewhere in the middle, but investors tend to get very, very euphoric in good times, and they get very, very depressed in bad times. And if they could just moderate that a little bit, then they'll be much, much better off in their financial futures.
Oh, I love that. It's never as bad as it seems. It's never as good as it seems. It's right. Speaks to my heart in feeling like, being present with what is.
Yeah,
exactly. Right? Like what is right now? And be present here and take stock versus being so either euphoric or depressed, right? On the pendulum swing, right?
Yeah.
How come back to the middle. So thank you. I love that.
You're welcome.
And let's talk a little bit about a question from our favorite. He's basically an honorary, podcast member at this point, is Bob from Huntsville, who gives us.
We should have Bob on sometime.
Right? I think that would be a great idea. And then he could ask his questions live.
Perfect.
So I'll ask him if he wants to do that. But he was asking about that transition from work to retirement, and previous wisdom had always, like the recommendation, quote unquote, or the generic kind of advice had been, as you get into your retirement years, you pull your portfolio into a more conservative position. So if during your working years, younger, let's say your 20s and 30s and even 40s, if you're in aggressive or moderately aggressive investments, which means mostly equities, right? Maybe 80 to even 100% equities at some points. You're really pushing into the stock market. You're really pushing for growth of your investments, that as you get closer to, your specific date where you want to retire, that you start to step that back and you start to go more towards fixed income or towards bonds, which historically have had lower volatility, lower swings between, the high and the low. So maybe if in your 40s you're at 85% equities and 15% fixed income, when you're in your 60s, you're at 60% equities and 40% fixed income. When you're in your 70s, you're at 50% equities and 50% fixed income, right? So we're stepping back the risk and stepping up the safety over time. Now, I loved this question from him because that wisdom has been challenged over the last 15, 20 years or so, right? When our fixed income and our bond rates have been really, really low, which we can see with, even personal savings accounts, right? That when they're at 0.005% interest for an entire year, that has been reflected across the board with bond rates, fixed income rates, money market rates have just all been really, really low for a long time. So over the last couple of decades, there's been a swing. We've talked about this on the podcast a little bit before, a swing towards staying more in equities so that you actually get some growth, so you keep up with inflation, right? So you're not, in investments or bonds that are giving you 1% per year and inflation's at 3-4% per year. But are we moving back into, maybe an environment where we can shift a little bit? What do you see, and how would you respond to that?
It's a great question, and I think you've couched it in a very good manner, because really this started in 1986, where all of a sudden the tax code was changed to prefer capital gains over dividend income. Okay, and so what happened is that also happened to curtail or dovetail or kind of coincide with inflation just being crushed by Paul Volcker and coming into a secular downtrend for inflation all the way until 2021. So many years of disinflation or very, very low inflation, which we just now we're currently battling the other way. In 1986 to 1990 or early 90s, what you saw mostly was people who were retired would have almost 100% in bonds and fixed income.
Wow.
You would have, retirees virtually with 80 to 100% in their portfolios. In fact, when I first got into the business managing money, I had to convince people to put 30% of stock, large cap dividend paying stock, into their portfolio so that they could keep pace with inflation. Because if you're at 65 and you have 15 to 20 years left in terms of your life expectancy, your biggest risk is not a bear market in equities. Your biggest risk is inflation over that long period of time. And so we needed to keep the purchasing power on par that whole way. Now, as you said, as we've progressed through and we've had ultra low interest rates, people had to go into equities, even for income. They had to go into high dividend stock. They just had to take the risk of volatility that was inherent in equity markets. And because we had extremely low interest rates, we had the Federal Reserve very, very involved in structuring the yield curve for a very long period of time during that, 2003 to 2023. And now they're having less of an impact as quantitative tightening is occurring. The interest rates are back at more normal type levels. I think a lot of people who are retired are going to have to start making that decision. How much equity risk do I want in my retirement? So to Bob's question, the general rule of thumb, and I'm going to caveat this after I say it. The general rule of thumb is as you get older, you get more conservative because your temperament won't be able to handle the large swings in value. For example, when you're 35 years old, Bob, you're successful, making pretty decent money. Your net worth is really starting to grow. You took equity risk to grow your purchasing power, to grow your asset base. 65, 75, I mean, sure, you want to grow it enough to keep pace with inflation, but what else are you growing it for if your needs are already being met? You may have a certain legacy goal. Perfect. That's totally acceptable. That's great. That's wonderful. But it also goes to goes to our point last week, which is that general rule of thumb may not work in any or in a lot of situations. Everybody's personal financial goals, their financial situations may be different in retirement from another person. So you need to sit down and work with your CFP to come up with the best risk profile that you can tolerate going forward and expect it to change over time. For example, I have a client who just retired. Okay, so just retired. And we actually split the money into 4 different buckets: emergency cash, income, lifestyle income cash, legacy, kind of what the kids are getting, and then charity. So we actually have 4 different accounts that hit all of those different needs. Now, whether we actually split it out into 4 different accounts or it's in one account, but 4 different portfolios is irrelevant. But at this point, it's a general rule of thumb to get more conservative, particularly with bond yields being as high as they are right now. But it really is a personal decision between you, your spouse, if you have one, and your financial planner.
So you basically just read my mind, because I was going to say there that it could also be not, it might not be one strategy, right? Like that's exactly where I was going to go with that next step, is that if you have the means and the desire, right, to leave a legacy to your, kids and grandkids, or leave a charitable or philanthropic legacy as well to a cause that matters to you, those funds, depending on how you want them to be used or how you want them to grow, it's going to be a very different strategy from how do I create the income that I need to be able to regularly, easily, support my normal everyday life. So
Exactly.
yeah, I love that. I love that example of whether it's literal, 4 different accounts that you can see, or if it's like, okay, I know this part of my portfolio, this bucket is my income bucket, and this bucket is my legacy bucket, and this bucket is my philanthropic bucket. We can have different goals in place if you have, that level of assets where your income needs can be covered for what you actually need from a day-to-day basis.
Yeah, and it might be you have almost all of it in the income bucket, in which case that's fine. You still have the other buckets. It's just they're probably smaller than your income bucket. And so everybody has to really kind of go through that process. But generally speaking, the older you get, in my experience, the less willing and able clients are to tolerate the big up and down swings of the equity market, and they want the more consistent cash flow income, the promise of getting their money back contractually with a bond. And so that's generally what I see happening over years.
So the two, ooh, hold on. My sound here is being one. There we go. We're good. I'm back. The 2 examples that are coming to mind right now. So I have a client who's in her mid 80s. All of her income needs are covered through, she has pension and Social Security.
Perfect.
And she's like, I don't know what I need this money for.
Yeah.
Right. So, like, truly, she's good. Right. From her perspective of like, I get enough of my income from Social Security, from my pension, and this, the stuff in my portfolio. Like, how do I start to give it to my kids and my grandkids?
Yep.
That's the kind of planning that we're doing. So for her, when it like moves up and down, she's like, oh, that's interesting. I don't really care.
Exactly, because she already has it earmarked. She already has all of her financial needs met, and she's just earmarking it. She knows it's not over my lifetime, it's over my kid's lifetime, which is generally 10 to 20, 25 to 30 more years of life left. So again, growth becomes a much, much more important part of that,
Right.
as opposed to income, which she obviously has that covered very well.
Exactly. Yeah. So if you're not in the, in a space where you will be retiring with a pension, which, even people in their, 50s and 60s now, that might not be the case. Um, so then your income bucket, right? Then you have been building your own income bucket. Social Security is going to be one line item of income, but your portfolio is then going to serve as the rest of the income that you're going to need. So yeah, it'll be a different conversation, but I just wanted to like throw that out there as an example of, yeah, there are times, and even for her, for my client who's in her mid 80s, there were years where they pulled money from the portfolio. They needed it for different things. And so it kind of goes to that. One of the things we kind of talk about is go, slow go, no go over time. And people don't really want to think about that all the time, right? So when you retire, you're like, no, we're going to go, we're going to travel, we're going to do all the stuff. And there does get to be a point for most people, not everyone, but for most people, there will be a point where you're like, I've been a lot of places and I kind of want to stay here, right? I want to stay here. I want to be with my friends. That particular client, she goes to lunch with her friends. She goes golfing. She's mid 80s, right? She goes golfing with her friends. She goes out, but travel is kind of like, I'm kind of done with that at this point in my life. And so we really do see the full life cycle in that regard as well, that yeah, there likely will be a time where you're like, I'm good. I'm gonna just stay a little more close to home. You do start spending less money if you don't have, high medical costs for things. Um, and it's interesting. It's interesting to take that into account over a lifetime where it's not always going to be the same.
No, it's not. A portfolio has to fit your life, not the other way around, which I think I've mentioned. I have a younger client who is fairly wealthy and he is very conservative. Okay. He fits the profile. He does not fit the profile. Again, these rules of thumb, right?
Right.
He doesn't fit that profile. His profile says he should be very aggressive. And that is not who this individual is. And I would never have him in a portfolio like that because it exceeds his emotional tolerance to be able to do that. So that is not what a portfolio is for. A portfolio is to help you achieve those goals, but to make those goals um, realistic enough given your risk profile.
Mm-hmm. Beautiful. Well, hopefully that answered the question, Bob. If it did not, feel free to let us know what else you want to know about that, and anyone else. True, too. If you have what you think is a unique situation, we're not going to give like specific financial advice, right? But if you have, thoughts around, hey, what if I really want to leave a big philanthropic legacy in some way? How do I start to talk about that? We can absolutely talk about some of that on the podcast as well in general terms. So let us know.
Absolutely.
Let us know what that looks like. So let's talk a little bit now about options. We have a few minutes left, so we're not going to go. This is not going to be a masterclass on options, okay?
Are you sure,
Because
Hannah? We could certainly do it.
we could, and if people want, let me know. Again, send us comments, send us questions. Um, that could be a fun. Okay, I'm putting fun. I'm playing it fast and loose with the term fun here, but for you and me, that could be a fun like masterclass or webinar to give one day. Um, I know not everyone would be into that, but we could really nerd out on options for a while.
Oh yeah. Oh yeah. Options are definitely an area to do that in.
So what I wanted to kind of illuminate about options for our listeners is not to go into again the nitty-gritty details of what they are and how they work, more of a um, high level explanation of what they are, what you're doing when you buy or sell an option, and why they've come into the collective consciousness lately. And what I'm going to use as an example here is the quote unquote meme stock trend. that we've seen with things like GameStop, or, buying options on, some of the bigger stocks. Tesla, I think, gets a lot of option trading. And so,
Very much so.
yeah, let's talk about, because when we mentioned this last week too, when your barber starts talking about, the different stocks that they want to invest in, that's time to start questioning things. And I feel like we've hit that point with options trading as well, where it's like when your 18-year-old is like, hey, I'm going to trade these options, like, all right, we need to have a little bit of education around this topic so people know what they're getting into.
Yeah, I would agree. So just as a kind of a preface, if people think about the word option and what the definition of an option is, or, when you're going to eat, you have the option to go to restaurant A or restaurant B, right? So it's a choice. And that's all an option contract in the financial markets does. It just gives you the right to choose to do something or to not do something. Okay. So it's why we call it an option contract, because it gives you the choice. And so there are two types of options. One is called a call option, and a call option makes money when a stock goes up. Okay. So each option is based on an underlying stock or an ETF, an exchange traded fund, or an index. Okay. Or there's a bunch of other things that they're based on, but it's why they call them a derivative, is they derive their value from this underlying stock position. Okay. So they derive their value from an underlying stock position. So as that stock goes up, that call option value goes up, and it makes it valuable. Okay. Why do people like to buy call options? Well, they do because, for example, if you have 100 shares at a $10 stock, you'd have to come up with $1,000 to purchase those 100 shares of that $10 stock. Okay. A lot of people, that's a lot of money. And so what a call option allows you to do is, for a couple of $100, buy one options contract, which effectively you then derive value from 100 shares of that stock. So for a very little amount of money, a couple $100, you can gain the value of that 100 shares going up in value. So it gives you leverage. Okay. So instead of having to put $1,000 in, you have to put a couple $100 in. So, but yet we still get a very high rate of return if the stock goes up, because it's leveraged. Okay. So that's really important to understand. Similarly, the second type of stock of option is called a put option. A put option is if you think a stock is going to go down, you would buy the put option. It allows you to sell back your shares at a predetermined price. So, for example, if we have that 100 shares of XYZ, which is priced at $10 a share, but we think it's going to go to $7 a share, and we're scared because we own it, right? We think it's great long term, but over the next 6 months, we don't know. It could be kind of a crazy time, and that worries us. Well, what we can do for a couple $100, again, we can go in and buy a put option on XYZ stock. That allows us to mitigate, or to earn money as the stock price drops. The value of our put option goes up. So when you combine the two together, your loss is defrayed or diffused quite a bit. It's defrayed quite a bit. So it's just a way for people to protect the value in the short term of one of their stock holdings. But the reason why people are using these many times, unfortunately, Reddit, the meme stocks, people were using a lot of options, is because that leverage. They're using it as a speculation, as a speculative device, saying, hey, I think in the next 2 weeks, Tesla's going to go up by $50 a share. Well, I'm going to buy 2 call options. That way my return is very, very, very high because I'm making a lot of money per share on my option. And I only had to put a little bit in, a fraction of what it would cost otherwise. So for higher dollar, higher priced stock like Tesla or Amazon or a couple of the others, people will go into options because it allows them to have that leverage for a much, much smaller commitment of money.
So again, we could go into lots of details about how call options work, how put options work, that you can buy a call or sell a call, you can buy a put or sell a put, right? There's all of these different ways that those transactions can work and make money or protect downside. But I wanted to hone in on the speculation piece of it, because I think that's where things got, I don't want to say out of hand, but that's where, where it was like, ooh, it feels like we can game the system in this way. And while some people made a lot of money doing that, and then they went and talked about it all over the place, most of the people that followed on to be like, oh, I can do that too, then just lost everything that they tried to speculate with, because it is speculative to do that, right? So I would love for you to talk a little bit more about the reason to use options versus like what it looks like when you're speculating by using options. Can you expand on that a little bit?
Yeah. So options are a wasting asset, meaning there is an expiration date, and on that date, they stop trading. They go away. They disappear. They're no longer there. And so it's something that every client that uses an option has to understand, that these are temporary positions only to do certain things, right? Either speculate, generate income, or to hedge or to protect the downside of a position. And so that speculation, unfortunately, has cost people a lot when they don't realize that it can go to zero, that is an actual outcome, potential outcome in these types of assets. So, in fact, during the meme stock craze, I believe there was a online broker dealer new to the game who allowed an individual investor to make a ton of money in options by allowing that individual to leverage the leverage, if you will, to take margin loans out to buy options, which this individual was spectacularly successful for a short period of time before it went to zero.
Mm-hmm.
And then sued because he didn't realize that he had to pay back the margin loan. Okay. So,
Ouch.
yes. So both the individual and the broker dealer got in trouble. The broker dealer actually was written up by the SEC and fined for allowing a newer investor to do that, to get themselves into that kind of trouble, because he wiped out his entire account. His account went to negative. So let's say you had 100 grand in there, that's great. But if it's all in options and it's levered, it could go negative value pretty quickly. So I want to make sure people understand that the price of options in and of themselves is very, very volatile. Okay, it can go up and down a lot. It's why on a call option, the upside is unlimited. Mm-hmm. The downside, if you buy a call option, is only the amount you put into it. Okay, that's the most you can lose, is just the amount you put into it. Similar with the put. The most you can lose is the amount you buy into it. The amount you can make is very, very high. I mean, if the position goes bankrupt, you know, if the underlying company goes bankrupt. But it's something to really watch out for, that these instruments are very complicated. It's not for the faint of heart. And I would definitely have a professional guiding you in using these, because there's only three different things to use them in, as we've talked about: generate income, to speculate or to gain a more exposure, or to protect on the downside. So those types of and there's lots of different strategies that go around that, which again, we could probably go on for a week or so, but it's really important to know that if you want to learn about it, you certainly can, but I would just be very, very cautious. I've known more than my fair share of people that have lost entire accounts because they were trading options and it went against them.
So when we at Juncture are using options, because we do use them for those purposes that you know, options B and C that we just talked about, the ability to generate some additional income, right? If you use them in a couple of certain ways, you can pretty reliably make a decent, you know, little extra income in your account.
Correct.
And the protective side, you know, there are ways where, again, the most that you'll possibly lose is what you spent to buy the option. And then it's protecting you on the downside if you need to utilize that option to sell your stock for whatever price, right? So we do utilize options in our portfolios when called for or when desired by a client, right? But not, we don't use them speculatively, I would say, right?
Yes and no.
Yeah,
so
interesting.
90% of what we do with options you're exactly correct. We either protect the downside or we generate a more an income flow from assets we already own. Okay. There is a very aggressive strategy, which you actually have to be approved by me if you want to participate in, that magnifies the upside by using a call option when we go through a bear market. So for example, we just went through a bear market. Some call options were purchased in certain accounts, and as the market healed, those options went up in value quite a bit, and then they were sold as we got close to the peak, which, I mean, we peaked probably 2 or 3 months ago. So
well, you know what I love about that is that we just talked about all of the different ways that they can be used, and that for people who are in that bucket, they're like, yeah, let's do it, let's try. We actually have the ability to do that as well, as long as, like you're saying, you're very, very clear that this could go, you know, when you're speculating, there is the higher chance for a lot of volatility. And if you're okay with that, here's how we do it professionally. I love that.
Yes. We don't use the speculative word when we're talking about it, but we make very clear that they know that when we buy these, the market is down a lot, right? In 2022, the S&P 500 at certain points was down 25%, 26%. And those are about the time we purchased those call options.
There you go.
So,
timing's everything.
Well, I mean, they're volatile, so you kind of have to kind of put them to the side a little bit if you're a client, because they're going to go up and down a lot. But when they go up, they do add they add some exposure to the portfolio, which means as that equity market heals and comes back up, you're participating more on the upside than you did on the downside. And that's what we call asymmetry of returns. And that's what, at Juncture, at least, we really strive for, is a muted downside or a managed downside, and yet a fully participating upside. or in certain aggressive accounts, a magnified upside. So we're trying to get that asymmetry correct for a lot of, individual investors, families, and charities. So.
Well, as always, Brad, I appreciate especially the financial risk manager side of you, that FRM designation that you hold that not very many people hold, right? Like that's a pretty unique one. And I love the perspective that allows you to bring to these conversations where a financial risk manager, it doesn't mean you don't take risk. It just means you understand how to really contextualize it and put it into, practice as well. So thank you. I appreciate that.
Yeah, you're welcome. You're welcome.
Yeah. And if anyone has questions, again, love it. We love the conversation. We love to answer your questions, and we'll be back next week for more. Thanks for being here, Brad.
You're welcome.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at hannah, HANNAH, @expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.